This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to the program. We are diving into a packed agenda today, covering everything from the massive infrastructure costs of artificial intelligence to the shifting landscape of the global airline industry.
Utilities are spending trillions to power the AI boom.
Stock markets recover as Middle East peace hopes rise.
First-time homebuyers face the most expensive market in decades.
Nigel Farage becomes the new face of British crypto.
United Airlines considers a massive merger with American Airlines.
A scam victim shares her journey of financial recovery.
Salesforce reshuffles leadership to tackle the generative AI threat.
A global memory shortage is making your laptops pricier.
Let's start with utilities. The race for artificial intelligence isn't just happening in Silicon Valley software labs. It is playing out in the physical infrastructure of our power grid. A new report from the consumer education nonprofit Powerlines reveals that investor-owned utilities are on track to spend a staggering $1.4 trillion on capital expenditures by 2030. This massive investment is largely driven by the insatiable electricity demands of AI data centers, which require far more power than traditional computing. Companies like Duke Energy, Southern Company, and American Electric Power are leading the charge, planning to build new power plants and transmission lines at record-breaking levels. Duke Energy alone is planning to spend over $100 billion to meet demand in states like Florida and the Carolinas. This isn't just a corporate expense, though. It is a cost that is increasingly being passed down to everyday consumers through their monthly electric bills.
That is exactly where the tension lies. These utilities are seeking state regulator approval to recoup these massive infrastructure costs from their customer bases. In fact, electric and gas utilities have already sought to raise customer bills by $31 billion in 2025, which is more than double what they asked for in 2024. This has sparked a fierce national debate over who should actually foot the bill for the AI boom. Should it be the tech giants like Microsoft, Meta, and OpenAI who are the primary drivers of this demand, or the average homeowner? Some regulators are starting to push back. For instance, American Electric Power recently faced a battle in Ohio over a proposed tariff that would require financial commitments from data centers before they can even connect to the grid. As the grid modernizes to support AI, the financial burden on the American public is becoming a central political and economic issue.
Next, the global markets. Global stock markets are showing remarkable resilience as they recover losses tied to recent geopolitical tensions. Hopes for a peace deal in the Middle East are pushing equities higher, with the S&P 500 closing in on a record high. This rally comes after the index managed to recover all the ground it lost since the conflict began in late February. The optimism is spreading globally, particularly in Asia, which is often the most vulnerable to energy shocks. Japan's Nikkei and China's CSI 300 have both hit 6-week highs, reflecting a growing belief that diplomatic talks between Washington and Tehran might actually yield a breakthrough during the current ceasefire. Analysts note that the Nasdaq has now risen for 10 consecutive sessions, its longest winning streak in years. It seems investors are choosing to look forward toward a potential resolution rather than dwelling on the current stalemate in the Strait of Hormuz.
It is a fascinating shift in market sentiment. While the situation on the ground remains incredibly tense, with the U.S. still blockading Iranian ports, the financial markets are actively pricing in the end of this geopolitical chapter. There is specific talk about nuclear negotiations, where a compromise on uranium enrichment feels increasingly realistic to many observers. Even Donald Trump has weighed in, suggesting that peace talks could resume in Islamabad very soon. This shift has also impacted the currency markets, with the U.S. dollar lingering near 6-week lows as it loses the gains it made during the height of the war fears. However, we aren't out of the woods yet. Traders are keeping a very close eye on upcoming economic data, including the IMF's fiscal monitor and manufacturing indices, to see if this rally has the legs to sustain itself through the rest of the month.
Now to the housing market. For many aspiring homeowners, the dream of buying a first house is becoming a financial nightmare. A recent analysis of census data by the Economic Innovation Group shows that it is a historically bad time to enter the market. New homeowners are now spending 26% of their income on housing costs, compared to just 20% for those who bought their homes years ago. This 6 percentage point gap is the largest on record since at least 1990. To put that in perspective, that 6% difference represents over $5,000 a year for the median household, which is more than half of what a typical family spends on food annually. The story of Aaron Solomon, a 37-year-old in New Jersey, illustrates this perfectly. He and his wife waited for prices to drop after the pandemic frenzy, but they never did. They eventually bought a $1 million home with monthly payments of $6,000.
The reality is that even as mortgage rates have fluctuated, home prices have remained stubbornly high due to a severe lack of inventory. This creates a massive divide between the haves and the have-nots in the housing market. Those who bought before the recent surge are locked into lower rates and lower prices, while new buyers are forced to stretch their budgets to the breaking point. Solomon mentioned that the sticker price of his home would have been unimaginable just a few years ago. This trend is forcing many young professionals to rethink their entire financial lives, often sacrificing savings or other essential spending just to secure a roof over their heads. With housing costs eating up such a significant portion of take-home pay, the long-term wealth-building potential of homeownership is being called into question for an entire generation of Americans who feel they are simply priced out of stability.
Moving to UK politics, Nigel Farage, the leader of Reform UK, is making headlines again. But this time it isn't just for his political rhetoric. He has become the prominent face of a new cryptocurrency venture called Stack BTC. In a high-energy promotional video, Farage is seen alongside former Tory Chancellor Kwasi Kwarteng, celebrating a £2 million Bitcoin purchase. Farage himself has invested over £200,000 in the company, which functions as a Bitcoin treasury. The goal of the business is to accumulate the digital currency, meaning the company's share price is directly tied to the performance of Bitcoin. This move has drawn sharp criticism from political rivals. The Liberal Democrats have even called on the Financial Conduct Authority to investigate whether Farage's promotion of the currency constitutes market abuse. They argue that politicians should not use their public platforms to potentially enrich themselves or specific vested interests, especially given Reform UK's policy stances on crypto.
It is a controversial intersection of finance and politics. Farage and his party have previously called for the deregulation of the crypto industry and even proposed a national Bitcoin reserve fund. Critics point out that by promoting Stack BTC, Farage is incentivized to see the price of Bitcoin rise, which aligns perfectly with his political advocacy for the sector. Kwasi Kwarteng's involvement is also raising eyebrows given his history with the disastrous 2022 mini-budget. Kwarteng once described cryptocurrency as a total crapshoot, but has clearly changed his tune as he now chairs the business. The promotional video was filmed at the offices of blockchain.com and released just as Farage held a major press conference, ensuring maximum visibility. While Farage portrays this as a savvy investment move, the calls for an investigation highlight the growing concern over how much influence political figures should have in the volatile world of digital assets and private investment vehicles.
Next, an airline update. The aviation industry is buzzing with rumors of a potential mega merger that could reshape the skies. United Airlines CEO Scott Kirby has reportedly floated the idea of a merger with American Airlines to senior government officials. This follows earlier speculation about a partnership or tie-up with JetBlue. Kirby has been vocal about the stress high jet fuel prices are placing on the industry, suggesting that United is prepared to pick up the assets of struggling rivals. If a United American merger were to actually happen, it would be the most significant airline deal in over a decade, potentially creating the largest airline in the entire world. Such a move would further tighten the grip of legacy carriers on the market. However, industry experts warn that getting approval from federal regulators would be an uphill battle, as the government has recently been very aggressive in blocking consolidation to protect consumer competition.
The implications for travelers would be massive. While a merger of this scale could lead to more streamlined operations and a broader network, it almost always leads to less competition and higher ticket prices in the long run. Kirby's comments about picking up assets during a crisis suggest a predatory strategy aimed at consolidating power while smaller or more financially vulnerable airlines struggle with rising costs. We've seen the Department of Justice step in to block smaller deals recently, so the idea of the two biggest players joining forces seems like a long shot in the current regulatory climate. Still, the fact that these conversations are happening at the highest levels of government shows how much pressure the major carriers are feeling. Whether it is JetBlue or American, United is clearly looking for a way to expand its dominance, even if it means testing the limits of antitrust laws and public patience.
Now, a personal story. We are following up on the story of Wanapa Supercert, a woman who lost $300,000 to a sophisticated government impersonation scam. 2 years after the ordeal, she is finally beginning to rebuild her life. The scam was incredibly elaborate, involving fake law enforcement agencies and a criminal syndicate that forced her into a vow of secrecy and daily check-ins. She was so deeply manipulated that she even lied to her own family in Thailand to get them to send her money, which she then forwarded to the scammers. Today, she is working through the immense guilt of draining her aunt's retirement funds and her own savings. She has managed to pay off her credit card debt with help from friends and a GoFundMe campaign that raised $6,000. Her journey highlights the devastating psychological impact of these crimes, which often leave victims feeling like they were the ones doing the scamming.
It is a heartbreaking reminder of how effective these scammers can be at distorting reality. Supercert describes going to war with her past self, constantly replaying the events and wondering what she could have done differently. Therapy has been a crucial part of her recovery, helping her break out of a vicious negative feedback loop of self-blame. She has also found support by sharing her story publicly, which led to more people in her life reaching out to offer help. To manage her finances, she has had to make significant lifestyle changes, including cutting rent costs and working steadily in her role as a data analyst. While she still carries the weight of the financial loss, her focus has shifted toward forgiveness and moving forward. Her experience serves as a powerful warning about the sophistication of modern scams and the long, difficult road to emotional and financial recovery for those who fall victim.
Shifting to tech leadership, Salesforce is currently navigating what many describe as a fight for its life. As generative AI threatens to disrupt the traditional software-as-a-service business model, CEO Mark Benioff has assembled a core team of 10 executives to lead the company through this transition. An internal organizational chart reveals a significant executive shakeup that took place earlier this year, with new leaders stepping in to replace several high-profile departures. Key figures include Robin Washington, who serves as both president and chief operating and financial officer, and co-founder Parker Harris, who is setting the long-term technology vision. The company is racing to integrate AI agents into its products as a defensive measure against new competitors. Interestingly, Benioff keeps a relatively small circle of direct reports, compared to other tech giants like NVIDIA's Jensen Huang, who has 36. This streamlined leadership structure is designed to allow Salesforce to move quickly in a rapidly changing market.
The pressure on Salesforce is immense because AI could potentially automate many of the tasks that their software currently handles. This is why leaders like Sebastian Niles, the chief legal officer, and Srinivas Talapragada, the head of engineering, are so critical right now. They are tasked with navigating complex AI policies and scaling the technical backbone of the platform to support these new AI features. The departure of 5 major leaders since December suggests a period of intense internal change as the company pivots. Benioff is clearly betting on this new bench of executives to modernize the company's offerings before AI-native startups can eat away at their market share. It is a pivotal moment for the enterprise software giant, and the success of this leadership team will determine whether Salesforce remains a dominant force or becomes a relic of the pre-AI era of business computing.
Finally, the memory shortage. If you have noticed that laptops and gaming devices are getting more expensive, you can blame the global memory shortage. As AI companies gobble up massive quantities of chips to train their models, there is very little left for the consumer electronics market. This shortage of DRAM and NAND memory is putting significant pressure on the entire ecosystem. Research firm IDC warns that supply growth will remain below historical norms for the foreseeable future. Major players, like Dell and HP, have already begun raising prices across their product lines. For example, Dell increased the price of certain notebooks with 32 gigabytes of memory by over $200. Microsoft has also hiked the starting price of its Surface Pro from $999 to nearly $1,500. Even Apple is warning that supply chain pressures on memory will likely weigh on its profit margins as costs continue to skyrocket.
The situation, which some are calling Ramageddon, doesn't have an end in sight. Intel's CEO has predicted that there will be no real relief until at least 2028. This means that for the next few years, consumers will either have to pay a premium for high-performance devices or settle for less memory. Companies like Valve and Framework have already had to change how they sell products because they simply cannot get enough chips to meet demand. It is a classic supply and demand problem, but the scale of the AI boom has made it unprecedented. While tech giants are willing to pay almost any price to secure the hardware they need for AI, the average consumer is the one left holding the bill. As memory prices continue to climb, we may see a shift in how devices are designed, with manufacturers looking for any way to cut costs without sacrificing too much performance.
That wraps up our briefing for today. Thank you for joining us for this deep dive into the stories shaping our world.
Be sure to follow the show for your next daily update. We will be back tomorrow with more essential news and analysis. Have a great day.